shares are issued when the metal is deposited into the exchange. So right before the market collapses, it's at $115, $120 an ounce, record volume into SLV. It collapses, and right at the bottom, guess what? 38 million ounces of silver are deposited into SLV by an authorized participant at the bottom where the shares are created. Does it seem interesting that they sell it up here, they deposit it down here, and then the metal moves from the COMEX into the SLV vaults that are institutionally controlled by those commercial banks that issue the shares, and they continually do what's called share redemption and stand for delivery on metal inside the SLV ecosystem and GLD with great privacy. It's far more difficult to tell who did that than it is to look at the COMEX COT reports or the delivery reports. So lots of stuff going on. I think we could start with, well, we'll talk about gold and silver. Everyone's focusing on the March contract. But with the February contract, which completely is gone in a couple of days, right? Like 3 days. As of yesterday, for February gold contract, right? There were still 4,366 contracts open. That's 436,600 ounces, or 13.5 tons of gold. Now, what's unusual about that, in fact, insanely unusual, is that it's insanely high, that number for this late in the cycle. In fact, it's 24 times normal. It's even bigger than the upcoming March contract, which I don't know if that's ever happened. That's a massive red flag, and in really what it means, what most people would tell you it means, is a classic fingerprint of a big short that sold gold that they may not actually have to pay back. And if they were planning to buy it back, one would assume that they're somewhat trapped because liquidity is this late in the February contract is very thin. So normally when a contract goes off the board, like for example, the March contract goes off the board on Friday here, meaning it's time to either roll forward to probably the May contract, cash settle, or stand for delivery. And so when you see things this late into the February contract where there's that much gold that could stand for delivery that hasn't yet, it's very, 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 very unusual. And this is the kind of environment where, you know, everything that the West has done for a long time is all about confidence. And for a long time, no one questioned the integrity or motivation of the West or of the United States. But that might be changing. And the moment the market believes that there isn't enough gold, the leverage that has really been the hallmark of this industry or of this platform unwinds. And when the leverage unwinds and commodities, moves become really violent. But I think it's also important to look at the more explosive brother or sister or cousin of gold, and that's silver. Let's start with the February contract again, because you know, everyone's focusing on March, but I want to focus on the paper claims versus deliverable supply. It's important to understand that one COMEX contract equals 5,000 ounces of silver, right? We know that. And we've talked a lot about the deliveries. It's been really, like, as far as I'm concerned, all that people need to understand is that the biggest, most well-informed money in the world. In fact, since I met you, this is really what we've talked a lot about. I mean, we've talked about a lot of things, bricks and everything, but go back 5, 6 years, we started talking about deliveries coming out of COMEX with the others, and it's been what we've focused on, because the people that are standing for delivery in these quantities are well-informed, not just well-funded, very well-informed, and they know where the puck is going. Like Wayne Gretzky used to say, I don't skate to the puck, I skate to where it's going. And when you're spending 9 figures buying metals, in this case, every month, question needs to be asked, and the only question needs to be asked, who the hell is doing it? And where's it going? Now, the where's it going part, some people will debate. Well, a lot of it stays in COMEX, Andy. They'll say, okay, some of it does. That's called the eligible category, where it could be sold if wanted to be sold, but it doesn't want to be sold. I've mentioned how we have 8 Brinks facilities throughout the country. One is in New York City. That is a Brinks facility. A COMEX facility. Of the 8 Brinks facilities we have in North America, one is COMEX. It's Brinks JFK. And I have lots of clients in there that, and you probably do too, that have 1,000-ounce bars inside of the eligible category. They're not for sale, and they're not backing the bars that are listed on the COMEX exchange right now, although they could be if they wanted to. Anyways, so we've seen in February 4,639 contracts delivered. That equals, what does that equal? 23,195,000 ounces of, this is silver, by the way, excuse me, 23,195,000 ounces of silver. So 4,639 contracts times 5,000 ounces is 23,195,000 ounces. Okay, so that's about the low end of what we've seen since a year ago, November, every single month. Every single month it's been between typically 30 and 70 million ounces that stand for delivery. So that's a big deal, right? But here's a bigger deal. So while we have seen 23,195,000 ounces stand for delivery, in the month of February, we have seen 38,082,934 ounces leave COMEX. Leave. Now, if I keep saying this to put it in perspective, if a mint box of Silver Eagles weighs 42 pounds for 500 ounces, who took possession of 38,082,934 ounces? How many semi-trucks is that? And where is it going? And so I would say to you, the people that are doing this understand where the puck is going. The people that are spending this kind of money and withdrawing it out of the ecosystem, where the vault withdrawals are 164% of the February delivery demand so far, that means more metal is being pulled out than delivery alone can explain. This is highly unusual, highly. Let's talk about the March contract. Now, I haven't updated it over the last 2 days, but a couple of days ago, there was still 47,847 contracts in silver outstanding, with 4 days left till it comes off the board. That's 239.2 million ounces of silver. In contrast, the total registered silver inventory, that is the category of metal specifically earmarked for physical delivery, stands at 88 million ounces. What this is a paper Ponzi scheme, and it's a looming game of musical chairs. If even half of that open interest actually decided to stand for delivery, that's 120 million ounces with only 88 million ounces in registered. Do you see how that becomes a massive, massive problem? And so, I think that this is how stress shows up. It's not in price, but in the delivery mechanics. And when the paper claims tower over the deliverable pile, the market only stays calm until it doesn't. And then you look at what happened here in February, where 38 million ounces left the building, 10 million ounces more than stood for delivery. That is exactly what this is saying. It's that the people that want this metal do not trust the ecosystem. And at that level, at that kind of volume, at that kind of logistics, that should say something to people. So I think when you talk about where the metal is moving, whether it be standing for delivery here or the continued arbitrage that we see in Shanghai, where the silver price has been between $10 and $20 an ounce more than in the West, enticing arbitrage. Normally, an opportunity like that doesn't last very long as the sophisticated traders capitalize on that arbitrage. But when you realize that it is staying strong, that tells you that the Chinese are saying, look, we're choking on dollars. The dollars are not worth as much as the silver. Keep the arbitrage, keep that higher premium so that you get the traders who will buy 20 million ounces in the West and deliver it in China. Typically, there's a COMEX contract that goes right to Hong Kong, where a Brinks truck would pick it up, or a truck would pick it up and bring it to Shanghai. At a $20 or $15 or $20 an ounce premium on 20 million ounces, you're making enough to, change your life 10 times over. And are they doing it? Sure. And it's not even that premium that they're paying. the Chinese are paying to buy that. On top of that premium, there's a VAT tax. That VAT tax is not the responsibility of the exporter into China. It is the responsibility of the recipient when it leaves the Shanghai Metals Exchange. They will be charged a VAT tax. So they're willing to pay a 13, 14, 15% VAT tax and a 13 or 14, $15 premium on top of that to entice the Western traders to send it. That tells you where the real value of silver is, and the movements and the mechanics and everything we've seen so far in terms of price to the downside in many respects is contrived through raising margin requirements, through trying to squeeze the speculators out. And you can see that by the open interest, which is falling considerably. It worked. It did. And that metal then has moved into the strong hands who don't use margin, who I would venture to say over the next several days plan on standing for delivery in huge amounts. And now that Shanghai is open today and you see the price down a little bit, it's interesting as we get right to the end of the delivery cycle. This is what they're going to do again, where we saw before the price got hammered. Not only did JP Morgan cover 800, almost 800 contracts at the very, very, very bottom. Interesting how they did that. But how about SLV? During Silver Squeeze, SLV said BlackRock amended the prospectus, I think, on a Saturday night. And they said there's such inflow coming and there could be a lag between the time that we indeed confirm this as a good trade and when the shares are issued, because it's coming so fast and there could be a discrepancy there. Shares are issued when the metal is deposited into the exchange. So right before the market collapses, it's at $115, $120 an ounce, record volume into SLV. It collapses, and right at the bottom, guess what? 38 million ounces of silver are deposited into SLV by an authorized participant at the bottom where the shares are created. Does it seem interesting that they sell it up here, they deposit it down here, and then the metal moves from the COMEX into the SLV vaults that are institutionally controlled by those commercial banks that issue the shares, and they continually do what's called share redemption and stand for delivery on metal inside the SLV ecosystem and GLD with great privacy. It's far more difficult to tell who did that than it is to look at the COMEX COT reports or the delivery reports. So lots of stuff going on.